لا.
آه. آه. أنا ما في سلي عشان نقرأ شوف. نزل. نزيد الشارع.
Good evening, everyone. Today we are going to see the topic on financial risk management. One of the most important as well as the practical area in the modern business education is financial risk management. As the future manager and the leaders, you will constantly face some uncertainties. Whether you are working in finance or marketing, even supply chain operations, consulting field, even you just to be start one startup or whatever may be, every decisions you will take, that it's involves some level of risk. So in today interconnected and fast changing the business environment, the organization are exposed to market instability, credit defaulters, fraud, even cyber attacks, even operational failures, some of the financial unexpected shocks also. So, this is why understanding how to identify, access, and manage these risks. So, the risk is unavoidable. So, we want to be known how to manage these risks in no longer as well as it's optional. It is on essential managerial skills also. Previously, we know very well about the management students. The managerial skill is only for five, or otherwise we can say that post-corp systems, planning, organizing, staffing, directing, controlling, or otherwise we can describe post-corp systems. Yes, planning, organizing, staffing, coordinating, reporting, budgeting. These are the basically we can say the managerial skills. But nowadays in that modern business, the risk management also one of the managerial essential skills. Okay, so that's why I'm just to be decided to take the financial risk management today. So the purpose of this class is to give you a comprehensive as well as practical understanding of what financial risk looks like, how they impact the business, and what tools and frameworks we use to control them. Whether you plan to work in banking or corporate finance, consultancy, analytical field, even HR. So, whatever may be, this knowledge will help you make smarter decisions, avoid costly mistakes, as well as the contribute to stronger, more, focus on the organizations. So, by end of this sessions, you will be able to recognize different type of financial risk, understand how these risk measurement tools, like some beta, then liquidity ratio works are there, some cyber security risks are there. So how we can manage these risks, everything we can discuss about their today's sessions. Okay, so let's begin our journey into the world of risk, where the uncertainty meets the strategy and where good managers become great leaders. So, the introduction to financial risk management. The financial risk management is the structured process. Structured process of what? That is identification, I mean identifying, assessing, and managing the financial uncertainties that can negatively impact on organization objectives. In simple terms, we can say it's helped companies understand what could go wrong financially, how likely it is to happen, and what step should be taken on minimize the losses. So FRM, that is financial risk management is essential because every business, whether small, large or medium, face the risk due to some market fluctuations, credit defaulters, liquidity shortage, operational failures, or economical some external economic shocks also, right? So without proper risk management, even profitable companies can collapse during the unexpected events. So today FRM is a core functions in banking, corporate finance, even investment sectors also. So the bank use it to measure market instability, credit worthiness of borrowers, and capital adequacy requirements, whatever may be. Then that it's corporate finance terms use that FRM to protect the cash flows, manage the foreign currency exposure, and plan the financial strategies also. So the investment firms apply FRM to analyze the portfolio risk, diversing diversification of investment, and ensure the stable return of clients also. So as a management students, understanding FRM, financial risk management, is highly valuable because it built the analytical thinking as well as the decision making skills. Most leadership role today expect managers to interpret the risk reporters, understand the financial models, and support these strategic decisions with a risk aware mindset. So in we can say in that summary of that slide, financial risk management is not just about the avoiding losses. We want to be understand it is about enabling the organization to operating the confidentially as well as make informed decisions and build the long term financial stability. Why FRM is important for MBA students? Yes, because that financial risk management is crucial for MBA students because it's directly enhance their decision making capacity, even capabilities. In management roles, decision often involve uncertainty, whether it's budgeting, pricing, investment, or market expansion. FRM equips students with the structural way to analyze the risk, evaluate the outcomes, and choose the strategies that balance the growth and safety. So another key point is the risk management is used to across all industries, whether you work in banking, manufacturing, IT, retail, healthcare, whatever may be, logistics, consultancy, every sectors deal with financial risk such as cost fluctuations, credit exposure, foreign exchange risk, even the operational breakdowns. So this makes FRM that a universal skill that strengthen the employability and adaptability. So FRM knowledge is support leadership and managerial roles. The modern leaders are expected to anticipate the risk, build a resilience, and guide their terms during the uncertainty. So understanding FRM help the future managers communicate effectively with finance terms, auditors, investors, and top management. So making them more creditable as well as strategic. Additionally, FRM prepare that MBA students for financial responsibilities. such as budgeting, investment decisions, forecasting, and resource allocations. Even non-finance managers need to understand how their decisions is impact the company financial stability. FRM ensure that the students can handle these responsibility with confidential and analytical depth. Overall, FRM makes MBA graduates smarter decision makers, more strategic leader, and more valuable assets to any organizations. Sorry. Yes. Now we can discuss about, one second. Yes. Now we can discuss about types of financial risk. When we talk about financial risk management, the first step is understanding the major categories of financial risk that organization face or to meet. So these risk influence profitability, stability, as well as long-term growth. First one is market risk. Market risk arises from challenges in external market factors such as interest rates, exchange rates, even stock prices or commodity prices. For example, if interest rate suddenly rise, so the borrowing becomes expensive. If the currency value also fluctuate, so the importers and the exporters may suffer the losses. So the market risk is unavoidable, but it can be measured and controlled through hedging, diversification, and real-time monitoring. So as a MBA students, we want to be understand how to manage the market risk, because we can utilize the diversification strategy, we can utilize the real-time monitoring strategy, we can utilizing the hedging strategy. So second one is credit risk. The credit risk refers to the possibility that a borrower of counterparty will fail to meet their financial obligations. In banks, this means the borrowers may default on loan. In corporate finance, it refers on customers delaying payment or vendors failures to deliver. So, the poor credit risk management system directly affect the cash flow and profitability also. So the organization use the credit scoring models, rating, and exposure limit to manage. Yes. Then third one is liquidity risk. The liquidity risk occurs when your companies cannot generate the enough cash to meet its short-term financial obligations, especially working capital management. What is working capital management? The day-to-day operations we want to meet out. I mean the day-to-day expenses we want to meet out. So the optimizations, yes, lack of working capital also problem, excess of the capital, working capital also problem. So we can calculate the optimization, that is we can easily to manage the liquidity risk. Yes, so this does not always mean the company is unprofitable, but it may simply to enable to convert the assets into cash quickly. So the MBA leaders must understand the liquidity, become even a financially strong business can fall it if it does not have enough cash flow at the right time. Then operational risk. Operational risk arises from internal failures such as that process errors, human mistakes, even the technology breakdowns, frauds, or external events like cyber attacks likewise. So it is one of the most challenging risk because it is unpredictable and often linked to human behavior and organizational system. So the strong internal control, clear process, and robust IT system help reduce the operational risk. So, in summary, understanding these four major financial risks, the market, credit, liquidity, and operational, help manager identify where the vulnerabilities lies and how to build stronger, more, resilient organizations. Then we can see in depthly one by one. Yes, first we know that what is the risk, marketing risk, right? We can see the overview. The market risk refers to the possibility of experiencing losses due to the movement in market variables that are beyond the control of the organization. These variables, it's include interest rate, currency exchange rates, even the stock prices, commodity prices likewise. Because the market are constantly changing, this type of risk impact almost every business, especially those involved in finance, investment, or international trade. Then the key idea is the market risk is systematic, meaning it cannot be eliminated entirely through diversifications. Even if the company or investors spreads demand across sector or asset, its overall market momentum. So, like that geopolitical events, inflations, or policy changes can still cause the losses. So the market risk affect different organization differently. Example, banks. Banks face the market risk through interest rate changes and currency fluctuations affecting loans and foreign investments. If you take investment firms, see portfolio value rise and fall with stock market instability. Then corporate, any corporate may deal with currency exposure if they import or export goods or commodity. The price changes if they depend on raw materials like oil, metal, or agricultural product. So one of the reason why studying market risk is important is that it teaches the managers how the external economic factors influence the business outcomes. It encourages decision makers to track the global trends and analyze the financial data and strategically plan for uncertain environment. Overall, the market risk remind us that business operate in a dynamic and interconnected economy. So understanding this risk allow the managers to manage better strategic decisions and build the resilience again, that it's a violate the financial conditions. So the market risk, yes, especially VAR, that is value at risk. Yes, beta and volatility. That is, when studying the market risk, the important concept help us to measure and understand how the exposed, yes, how the exposed organization or investment, yes, is to market fluctuations, especially value at risk. That is the beta and volatility. It's mean, the value at risk, the maximum loss expected. The VAR is a statistical measures that estimate the maximum loss on organizations or portfolio might face over a specific time period under normal market conditions and at a certain confidential level also. So, for example, uh, one day, yes, a VAR of 10 lakhs, you just to be imagine, at 95 percentage of confidence means the firm expect not lose more than 10 lakhs on 95 out of 100 days. That is the meaning. So the VAR is the crucial because it's helped the managers quantifying the potential losses, set risk limit, plan capital reserves, and prepare for market stocks. So it convert uncertainty into a clear numerical estimate the decision make can use. Second, beta. That means sensitivity to market movements. Beta measures how sensitive a stock or portfolio is to overall market movements. A beta of 1 means the investment move in line within the market. The beta greater than 1 means it indicate higher volatility than the market. So the assets is riskier but may offer high return. The same thing, the beta less than 1 means, the lower volatility. That is, and potentially more stability. Yes, but the return also may be low. So, for example, the MBA students, you want to be understand beta is important because it's help to evaluate the portfolio risk, understand the assets behavior, and make the informed investment decisions is a widely used in portfolio management and capital budgeting models, right? So then volatility, that is the price fluctuations is over time. The volatility represent how much the price of an asset changes over the time. Higher volatility means the price move more dramatically, indicating greater uncertainty and risk. But the volatility is influenced, that by market demand, economic data, even new events and investors sentiment also. For risk managers, monitoring the volatility is essential because it's directly impact the trading decisions and pricing models and hedging strategies also. So together, we are value at risk, beta, and volatility. It's provide a comprehensive picture of market risk. So if in simple word we can say that VAR means it's qualify the potential losses. Beta explains the sensitivity to the market, but the volatility it show the degree of uncertainty in price movement. So understanding these three matrix enable the managers and investors to make more calculated and risk aware the financial decisions. Then credit risk. Credit risk refers to the possibility of, possibility that a borrower, customers, or counterparty will fail to meet their financial obligations. So the result is losing for the lender or the organizations. In simple terms, it is the risk of non-payment, either delayed payment or complete defaulters. So this type of risk is especially critical in banking and lending institutions. So where the loan repayment from the core of the business, however, the credit risk is not limited to banks. So the corporate, suppliers, investors, even governments face credit risk when they rely on other to pay them. So the credit risk arises in several common situations. When the bank gives loans to individual or business, when companies sell goods on credit and customers delay payment, when bond investors invest in companies that may default, when counterparties in financial contracts fail to fulfill their commitments. So if credit risk is not properly managed, it can severely impact the cash flow, profitability, especially overall financial stability. So even if your business is performing well operationally, losses due to non-payment can interrupt the operations and da- I mean damage the long-term sustainability. So for the MBA students, understanding credit risk is important because it teaches how to evaluate the financial reliability, assess the consumer behavior, and make safer the lending or investment decisions. Whether you are working banking, finance, supply chain, or corporate management, or credit risk evaluations become the key part of strategic planning. So overall credit risk is about balancing the growth with financial safety. By understanding who you are dealing with and how likely they are to repay, organization can protect themselves from unexpected losses and maintain the healthy financial operations. Then credit scoring and credit worthiness. When assessing the credit risk, one of the most important steps in evaluating the credit worthiness of a borrower. This helps the organization determine how likely it is that the borrower will repay on time. These major tools used for this evaluation are credit scoring models, the financial ratio analysis, and behavioral scoring. The first credit scoring model. The credit scoring model uses these statistical techniques and historical data to assign a numerical score that reflect the borrower's profitability of default. So these models, that consider the factors such as income, repayment history, existing loan, and age of credit accounts, and past you know delinquencies. So the banks and financial institution rely on these courses to decide whether to approve a loan or how much credit to extend, what interest rate to change. So the credit scoring make the lending decisions faster, more objectives and data driven. So the financial ratio analysis for corporate borrowers, lenders use the financial ratio to evaluate the company's financial strength and its ability to repay. So some key ratio includes liquidity ratios. Does the company have enough short-term assets to pay bills? Leverage ratio. How much debit is the company carrying? In profitability ratio, is the company generating enough income to meet the obligations? So these ratios help the lenders understand whether the borrower has stable cash flow, manageable debt and strong financial foundations. Then behavioral scoring, it consider, the looks at how the borrowers behave over time, especially after the credit has already been granted. It's mainly considered payment habits, credit utilization patterns, late payments, spending behavior and changes in account activity. So this type of analysis is useful for credit card companies, banks, especially fintech platforms, because it's helped them identify the customers who might be at the risk of default, even if their initial credit score was strong. Together, these three tools give a complete picture of credit worthiness: credit scoring models, financial ratio, and behavioral scoring. Excuse me. Sorry. So, understanding these methods help the managers and financial professionals to access the risk accurately and make safer, more informed lending and investment decisions. Then liquidity risk. Excuse me. So the liquidity risk overview. The liquidity risk refers to the risk that an organization may not have the sufficient cash or liquidity asset to meet its short term financial obligations, even if it is financially healthy overall. In simple words, it's the risk of running out of cash when you need it the most. So the liquidity risk become a platform when a company has asset, but those assets cannot be converted in the cash quickly. So, or can only be sold at the significant loss. For example, real estate, machinery, or long term investment may be valuable but not immediately liquid, right? So there are two key type of liquidity risk is there. One is funding liquidity risk. Second one is market liquidity risk. The funding liquidity risk, when a company cannot meet payments such as salaries, interest, suppliers' bills, or loan repayment due to insufficient cash. The market liquidity risk means when the company wants to sell on assets but cannot find the buyers quickly. So, or must accept a lower price than expected. That is market liquidity risk. So the liquidity risk affect all kind of organizations, banks, corporates, startups, even government bodies. So for bank, liquidity is extremely critical because they handle deposits, and loan. So losing liquidity can lead to a bank run. Yes, that is major risk. For corporate, tight liquidity can interrupt the operations, delay projects, and damage the supplier relationship, etc. So the several factors can cause the liquidity risk, in including poor cash flow management, unexpected expenses, delay customers payment, that economic downturns or market interruptions. So even the profitable companies can collapse if they cannot maintain the healthy liquidity. So for your MBA students, you want to be understand liquidity risk is vital. So because it teaches how cash move within the business and why liquidity is often more important than the profitability in crisis situations. So the manager must always ensure that funds are available at the right time, not just eventually. Then liquidity risk indicators. To effectively manage liquidity risk, the organization must monitor specific liquidity indicators. First one is liquidity coverage ratio, LCR. The liquidity coverage ratios, its regulatory measures used mainly by banks. It requires banks on hold enough high quality liquidity assets to survive a 30 days stressed financial scenario. A higher LCR means the bank is better positioned to handle unexpected cash outflows. This is on important measures because it ensures financial institutions remain stable even during the crisis, like that economic downturn or sudden withdrawals. Then net stable funding ratio. The net stable funding ratio focused on the long term stability for banking funds. It ensures that the bank has enough stable funding like long term deposit or equity to support its long term assets. In simple terms, that net stable funding ratio check whether the bank is relying too much on short term borrowings. So the strong NSFR reduce the risk of sudden funding shortage or support long-term financial health. Then current ratio. The current ratio is used mainly in corporate assets. Short-term liquidity, it is calculated as current assets divided current liabilities. So the current ratio above 1 indicates that the organization can cover its short-term obligations comfortability. That is the meaning. So this ratio gives a quick snapshot of a company operational liquidity strength. Then quick ratio. It's otherwise called asset test ratio. So this quick ratio is a stricter measures than the current ratio because it's exclude only for inventory from the current assets. Remaining everything is same, right? So current assets minus inventory, yes, that is quick assets divided current liability. So this indicator is useful when inventory cannot be converted to cash quickly. So yeah, higher quick ratio suggests the company has immediate liquidity available if needed. Then cash flow tracking. So cash flow tracking involved monitoring daily and monthly cash flow and outflows. Even profitable companies face cash problems if money is not coming in at the right time. So by tracking cash flow, organization can spot shortage yearly, plan borrowings, and ensure timely payment to employees, suppliers, and lenders. So together, these indicators provide a comprehensive view of an organization liquidity strength. So the LCR and net stable funding ratio protect the banks from liquidity crisis. The current ratio and quick ratios help the corporate evaluate the short-term liquidity. Cash flow tracking, it's ensure real-time visibility and cash movements. Operational risk overview. The operational risk refers the risk of losses resulting from failures in internal process, the people, system, or from external events. Unlike the market or credit risk or operation risk is not driven by financial factors. It comes from the way an organization actually operates. So this type of risk is present in every organization in the competitive world, because the size or the industry, every business depends on human behavior. Yes, another thing is technology. Then even physical infrastructures also. So the small breakdown in any of these area, yes, human behavior, technologies, and physical infrastructures, any breakdowns in this area can lead to financial losses, even the reputational damage, even the disruption of services. So the operation risk can arises from wide range of sources, including human errors such as mistake in data entry, miscommunication, or poor judgment. In technology side, including IT outages, then software bugs or cyber security problems, then the process of breakdowns such as the weak internal control, ineffective workflow, then external events also, the natural disaster, theft, fraud, the political people disruptions. So these are the things the automatically, that operation risk may be occurred. The operation risk also unpredictable and can occur even when the business is performing well financially. For example, a cyber attack, the internal fraud incident, or server failure can occur without warning and create the major financial losses or service interruptions, right? So, since operational risk is unavoidable, so the organization focused on mitigations rather than the eliminations. So this includes establishing strong controls, training employees, investing in reliable IT systems, enforcing compliance, and creating business continuity plans. So the risk assessment, audit, and scenario analysis also help the organization identify the weak area before they lead to success. So as a MBA students, the understanding operational risk is crucial because it highlights more important than the process efficiency, technology reliability, as well as the human factors achieving the organization goals. So the leaders are expected not only to meet the financial targets but also to ensure smooth operations and resilience against unexpected disruptions. So the overall operational risk remain as that even the best strategies fail if day-to-day operations are weak. So that strong process, trained people, and robust system from the backbone of sustainable risk resilience organizations. Then financial fraud are types and red flags. That is, the financial fraud is a serious operational and financial risk that affect the organization across the every sector. So it involves the intentional deception that is carried out to obtain on unfavor and unlawful financial advantage. So understanding the major the types of fraud and recognizing yearly warning sign is essential for preventing losses and maintaining the organizational integrity. The types of financial fraud: one is the asset misappropriation. That is, this is the most common form of fraud and include activities such as theft of cash, misuse of company assets, false expense claim, that the payroll manipulations. So even the small internal theft, if repeated over time, can create the significant financial damage and its trust also. Then financial statement fraud. It occurs when employee or management deliberately manipulate the financial report to hide losses, inflate profit, and mislead the investors and the regulations. So example include fall fishing revenue, understanding the expenses, manipulating the accounts, hiding the liabilities. So these type of fraud is extremely dangerous because it mislead the decision makers and can lead to large scale corporate failures. Then cyber fraud. An organization become more digital, the cyber fraud has become one of the fastest growing risk. This indicates that hacking, identifying the theft, ransomware problems, and online payment fraud, everything should be lead. So the cyber criminals target both individual and companies, making cyber security awareness and IT control essential. Then red flags of financial fraud, that is, yearly deduction is key to preventing fraud from escalating. So some common warning signs include inconsistency in records, unexplained differences between financial report, duplicate payments, discrepancies in inventory records, or irregular bookkeeping entries may indicate manipulations or hidden activity. So unusual or suspicious transactions, that the transaction that appear out of pattern, such as sudden large payment, unexplained write-off, frequent adjustment, or payment to unfamiliar vendor, should raise the immediate concern. So unapproved changes in financial data or last minute adjustment before closing books are also the red flags. So together, these red flags help managers identify the unusual behavior that may require the investigations. So the being unaware of fraud types and warning signs allow the organization to strengthen the internal control, train employees, improve transparency, and prevent the significant financial losses. Then risk mitigation tools and controls. Risk mitigations refers to the strategy and action the organization use to reduce the impact or likelihood of financial risk. No business can eliminate the risk completely, but with the right tools and control, it can protect the itself from major losses and operate more confidently. The key mitigations tool include internal control, insurance, hedging, diversification, and credit checks. First, internal control. Internal control are the policies, procedure, and checks that ensure the accuracy, prevent the fraud, and maintain the operational efficiency. Hedging is used to protect against the market risk, such as the currency fluctuations, interest rate changes, or commodity price movements. So the companies use financial instrument like forward, future, options, and swap to log in the price or rates. Then insurance transfer the financial risk to one insurance company. So the business use insurance to protect the against losses from fire, theft, even cyber attacks, some of the liability claims, or natural disaster. Then diversification. So the diversification spread risk across different investment markets, suppliers, even different product lines also. So in finance, a diversified portfolio reduce the exposure to the poor performance of the single asset. Then credit checks help the organization assess the reliability of customers, suppliers, and borrowers. Before offering credit or entering into the transactions, the companies evaluate the payment history, credit scores, financial ratio, and behavioral pattern. So this reduce the risk of non-payment, defaulters, or delay, especially in sectors with heavy resilience. Reliance and credit sales. So overall, these mitigations tools and control the credit a strong risk management framework that protect the organization from uncertainty. So the MBA students and future manager understanding these tools is essential because the strategic decisions must balance growth with awareness and resilience. Then integrated risk management framework. An integrated risk management framework, it's provide a holistic structured approach to managing the risk across the entire organization. Instead of handling risk is isolation, this framework ensure that all type of risk, financial, operation, market, credit, right, so are managed constantly and effectively. The framework typically consists of 5 key areas. One is identify, second access, then monitor, then mitigate, and finally report. The identify, this is the foundation of risk management. The organization must first identify all potential risks that could impact their operations, finance, reputation, or strategy. Then access. Once the risks are identified, the next steps to evaluate the the likelihood and impact. So this help clarify the risk as high, medium, or low priority. Then monitor. The risk are not static, right? Static. So they changes over time due to market conditions, operational changes, employee behavior, or external events. So the continuous monitoring ensure that the organization can detect yearly warning sign. Then mitigate. The mitigate refers to the actions it's taken to reduce the profitability or impact of risk. This may involve, the internal control, process involvement, and diversifications, insurance, some technology upgrades. So these focus on strengthening the system and ensuring the organization is prepared to handle risk even effectively. Then finally, reporting. The reporting ensure that risk information reaches the right stakeholders, such as management, the board, or regulators, or employees. So clear, timely reporting improve transparency, support strategic decisions, and help the align risk management with organizational goals. So these 5 steps create a continuous cycle that help the organization stay reliant, proactive, and well prepared for uncertainty. So, conclusion and key takeaways of today's sessions. As we conclude, the sections on financial risk management, it is important to highlight the most important lessons that modern managers and MBA students must carry forward. FRM is not just a specialized financial functions. It is a critical leadership skill. It's required across all industries. So FRM is essential for modern managers. Today the business environment is full of uncertainties, market volatility, credit defaulters, security threats, operational disruptions, global economic fluctuations. So lot of challenges we having. So these challenges we want to face, yes, respond quickly. The FRM provide the mindset and tools to operate confidently in such a unpredictable world. Then strengthen the financial decision making. The financial decision making, whether it's related to investment, budgeting, or pricing strategy, always involve risk. Even if you take resource allocation, the risk also involved. So the FRM helps the managers always, that analyze the data, compare the alternatives, forecast the outcomes, and make the informed decisions. Then helps build a resilient business. Um, uh, Resilience has become one of the most important qualities for modern organizations. So the companies that understand their risk, plan ahead, and implement the strong control are better equipped to survive the crisis and maintain the steady growth. So the overall key takeaway is that effective risk management is a long-term investment. It strengthens the financial health, supports sustainable growth, and empower future leaders to balance ambitions with stability. For MBA students, mastering FRM will add the significant value to your career. So, regardless of the field you choose. Thank you once again. Yes, for your patience. If you having any queries, please ask me. But one thing, FRM, yes, in your resumes also, you just be added one more skill. Yes, financial risk management skill in skilled area. Definitely that skill is more helpful for you get more good job opportunity. If you want to include your resume as a skilled area in the FRM, definitely you want to be learn. Yes, you want to be understand more insights in the financial risk management area. I just to be shared this PPT in your group. Definitely you just go through. If having any doubts, you just contact to Aditya also. Yes, otherwise if you having any queries, please feel free to discuss. It's okay, fine. You don't have any queries, please leave the sessions. Thank you.